Hi there, my name is Kent Skornia, President and CEO of Krilogy, and this is Partner and Chief Investment Officer for Krilogy, John McArthur, and this is our June market update. John, lots going on in the market right now, a lot of volatility. The S&P actually is officially in bear market territory. That's just a few weeks after, really the NASDAQ was in bear market earlier. What are your thoughts? What does this mean going forward? What are you seeing in the research that you all are doing and managing the portfolios?
Yeah, I think it's worth just spending maybe a couple minutes of sharing some perspective of where we are. On Friday, the S&P 500 hit a almost 25% decline level from the peak that we had in early January. We've got more stocks making new lows relative to new highs for 30 weeks in a row now.
Last week was really one of the worst weeks in years.
Last week was the worst week since March of 2020. 11 out of the last 12 weeks are negative. So really tough environment. Yet, if we look at, from a technical analysis lens, we're at about a 2% level of S&P 500 companies that are trading above their 50-day moving average. For reference, March 23rd of 2020 and then December 24th of 2018, that number that was above the 50-day moving average in the S&P was only 1.2%. So that would suggest that...
So to put numbers on that, right? Yeah. You're talking about only 10.
A few stocks.
Out of the S&P 500, 10 companies.
That are trading above a short-term trend line. So,
And relative to those other moments in time, there was only 7. 5 to 7, right?
That's right. So, that's suggestive that we are nearing exhaustion levels of selling in the S&P 500. Of course, no one knows the bottom. No one knows if we've seen it, if we have to go lower. But certainly a lot of damage has already happened. I think the key, really since we've actually spoke 3 weeks ago now almost, the narrative has gotten more negative. The recessionary calls have gotten more prominent. And really, I point to the stinginess around the inflation numbers that just have not rolled over. The Fed has the ability to influence demand, which they're doing. We're seeing it in home sales and retail sales declining for 5 months in a row now, month over month, hit negative territory in May. So they're impacting demand. But if we look at CPI and some of the main components, on inflation, a lot of them are supply constraint related. So we've got used cars, new cars, furnishing, apparel. All of those have been, stubbornly high, and we really need to see a rollover in the inflationary data for the market to feel that the Fed does not have to continue with the, jamming on the brakes of monetary policy, so to speak.
Yeah, because the worry then is it jams it on way too hard. Right?
That's right.
And the brakes are hit, and
that's right.
Next thing you know, we have the R word, right?
That's right. A recession, being a foregone conclusion at that point. And really, the GDP numbers for Q1 were negative. Atlanta Fed's Q2 GDP estimates are near zero. So we're close, but I think at this point, there is an argument to be made that we're in a really significant growth scare moment. There's an expectation that earnings are going to get slashed. Again, we have not seen that yet. It's reasonable to expect that to happen. We'll know a lot more over the next few weeks if earnings come down. We've seen price to earnings multiples go from low 20s to now mid-teens based on 22 and 23 estimates. However, we have to acknowledge that if earnings numbers for the rest of 22 and in 23 get slashed further, there's a case to be made for mid to low 3,000s on the S&P if a sharper recession happens. Now, I think worth mentioning again, we're 25% down in the S&P from peak to trough, and the average recession in the last 12 is down 30%. So we're really close to the average recession from a pricing perspective at this point. Average bear markets can get worse, mid 35%. That gets us to the low 3,000 number. Again, that's still not probable at this point, but it's becoming more and more in the narrative in the financial media.
So conversations with clients are kind of float between a couple of different areas. One is clients are scared, a little nervous, excuse me, but they've also sort of been through this before.
That's right.
Pretty recent, and then the other side is I hear clients say, "What are the opportunities out there?"
Right. Yeah.
Because with that many companies down in the S&P 500, there's some really great companies still there, still making a lot of money.
Absolutely.
Throwing off a lot of cash.
It's a great point. It's important for investors to remember that oftentimes in these moments, the good get thrown out with the bad. These highly volatile moments with indiscriminate selling, which often happens, do create opportunities. And they help reset from a longer term perspective, healthier from a longer term market perspective. I think the other thing that needs to be discussed is that, historically speaking, the market bottoms sometimes long before the data bottoms. And so if we look at the recession of 1990, the market bottomed in October, and the recession wasn't official until April.
Right.
If we look at
6 months.
That's right, 6 months. Your reference of the COVID crisis at the beginning of 2020, March bottomed in March. The market bottomed, in March, and the recession wasn't official until June, so 3 months after the fact. So the market will forecast it. It will start to discount a lot of this in as it's doing in the moment. And we'll see a bottom in this market before the data starts to look better.
So we hear inflations, we hear stagnant growth. What is stagflation, and how big of risk is it?
Stagflation certainly becoming more and more front and center. By definition, it's characterized by high inflation, slow to low growth, and high unemployment. We certainly don't see the high unemployment or anything close to it at the moment.
Yeah, because there's 2 job openings for every person looking for one position at the moment.
Right. Yeah. The job market is very tight. It's strong. Layoffs are increasing. We're anecdotally seeing that across the board, but not in a significant amount. And look, the Fed would much prefer a recession, as strange as that sounds, as opposed to a stagflationary environment, which is often a long slug.
Right.
It's
no
growth,
at that point.
low growth. That's right. Yeah. So they're doing what they can do to dampen demand and try to balance out some of the supply issues that we're experiencing. But the stagflation one appears more unlikely in a persistent type of way. The Fed, through their policy, has been pretty adamant in recent months about fighting the inflation issue, and it sure looks like they're going to be successful. The other thing I'll mention is that structurally our economy, with debts and deficit and demographics and technology, we have really a deflationary construct, structurally speaking. So it's unlikely for inflation to continue to persist for a lengthy period of time due to the demand destruction that's taking place and the policy that's happening as we speak. It's just a question of how long that takes.
Right. Well, when we're sitting with clients, a lot of times we're working on their wealth plan, right? We might be talking about estate planning, taxes, what are they doing with their charitable endeavors? Yeah. Now the meetings are portfolio. Let's discuss portfolio. What's happening? What is being done to protect the portfolio now? And also how are the portfolios positioned in the previous year or two? Walk us through what you all have been doing.
Yeah, so you're right. It starts with portfolio construction. Frankly, there should always be something in the portfolio that you don't love. Something that is not performing in an environment where other things are performing. That's typically some of the negative correlation benefits or non-correlation benefits, depending on what the portfolio composition looks like. But if we look at ourselves over the last 2 years and portfolio construction and process, we were a seller of bonds when the 10-year was at 60 basis points back in the summer of 2020. We reduced duration in our fixed income portfolios the summer of last year when the 10-year Treasury was at 1.4%. Same time, we reduced equity exposure in a number of models in exchange for hedged equity, which gave us some downside protection. So not only fixed income reduction, but equity reduction. And then, we're a buyer of bonds generally at these levels.
Right.
We bought fixed income and lengthened our duration in treasuries last week when the 10-year hit 3.5%. And we like the risk reward. So it's a constantly evolving process. It's not knee-jerk reaction. Typically in these high volatile moments, it's not the time when you want to make portfolio decisions. You want to be thoughtful, about the construction and the job of each of the constituents, and then navigate through it and make changes as appropriate. But reactionary amidst volatility typically isn't successful.
Creates disaster sometimes.
That's right.
I love the conversation that you hear in the media today, the financial news. Is the 60-40 allocation model gone, right? Broken. And they love to say it's gone, it's broken, because it makes great news. The way you all work and how your team works, it's not just about set it and forget it.
That's right.
And I think that's probably what they're speaking to when they say it is broken. It's those tactical moves you make throughout the year, over the years, that set you up for these opportunities to really protect the portfolio.
That's exactly right.
And then walk us through how you rebalance in times of volatility, because that has been happening over the last few weeks with all the volatility.
That's a technology-driven process that's run by our trade team that, in high volatile moments, we can take advantage of a dynamic rebalancing process that is really risk-driven. It's standard deviation-driven, and amidst highly volatile times, we can do some resets to get positions back in line with where we want them. So it's the discipline around whatever investor attempts to do, which is buy low and sell high.
Right.
It's not
trim the
perfection,
winners,
but
buy the losers.
That's right.
Yeah, take advantage of the opportunity.
That's right.
All right. So the spot we're in today, markets we have a bear market happening, down almost 20-25%. What can go right from here?
Yeah, it's a great question. The market is already expecting recession at some level, whether it's mild or severe. There is recession pricing that's taking place in the market. The high inflation narrative is pervasive. Rates have hit levels that we've not seen in many years. So the expectation is for that to continue to incline. From a yield perspective, unlikely. But if we look out to the other side, any type of moderation in inflation, again, it's not ultimate levels, but it's trend that will matter.
Yeah.
So any positive developments in easing of inflation will give the Fed permission to take the foot off the gas just a little bit in a midterm election year, which frankly, has some validity. I think the Fed would like to do that and not have too much influence in a midterm portion of the cycle. I think the other reality is that seasonality can be meaningful. If we look at 4-year presidential cycle, and even on a calendar year basis, seasonally we're entering a really good period. We've exited an historical really negative period, perhaps the worst period in a 4-year cycle, and are entering the best. And so that can provide some level of tailwinds. If earnings fear of earnings estimates getting cut is anything less than what's being projected or assumed, then that's a positive. So it's really about less bad as being positive than absolute levels in any one data point.
And it's going to be one of those moments where 6-8 months from now, and maybe not this moment, but from the bottom.
Yeah.
Right. People look back and go, "Oh goodness, I should have taken advantage of that opportunity." Right. And those are the moments in time where that disciplined approach to how you manage the portfolios is really key and critical.
Right. From an interesting observation level, anecdotally, the high flyers that in the easy money, highly liquid period that led things up, which are some of the non-profitable tech companies, biotechs, highly levered, Chinese internet and technology, those peaked back in 2021, early 21. So they led the way up, they've led the way down, 70 to 80% drawdowns on average. Very quietly, even as interest rates have surged to high levels, they're showing evidence of potentially having bottomed out 6 weeks or so ago. So in early May, from that reference point to now, you've got returns in some of those baskets that I referenced ranging from mid to upper single digits to mid 20% return.
Right.
And amidst a high interest rate. So we're seeing some divergences there, which are interesting. And it'll be interesting to see what happens going forward.
And you've always said, market cycles are healthy, and they always create new leaders in the next bull market.
Yeah. In terms of opportunities, that's one of the questions we've gotten from clients here lately. I think we've gotten away during various rounds of quantitative easing going back to 2009 and cheap and easy money. You're right. New cycles create new leadership, and we've had a 12 plus year cycle that's dominated by large cap technology and growth. And even though large value is down less than half of large growth year to date, from a long view multi-year perspective, there is still a pretty meaningful spread between growth and value. So we think it would be normal to see not only a gravitation back to mean and more balance between growth and value over a long-term cycle, which would make sense if we're in a higher interest rate, higher inflationary environment for a longer period of time. But looking at assets with cash flow and attractive valuations is really important right now. If we look at total return in the S&P going back to the 1930, 40% of total return is from dividends.
Right.
If we look at the 2010s decade, dividends were about 17% of total return. Mm-hmm. And then the first 2 years of the 2020s was 12% of total return. So I think getting back to cash flow, yield producing assets, returns are going to likely be quite a bit harder to come by going forward, given debts and deficits, valuations, policy rates, et cetera. It's important to not look at what worked in the past, but look
all of a
towards
sudden companies that make cash, that create cash, right?
That's right.
Always are important to hold in the portfolio.
That's right.
Well, thank you, John, and thank you all for your time today. And as always, we appreciate the opportunity to be stewards of your wealth and manage your portfolio. And if you have any questions, do not be afraid to contact your Krilogy Wealth Advisor. And we look forward to seeing you here again soon. Thank you.
Thank you.